Hey everybody, it's John Glougie with IA Private Wealth. Just wanted to check in with all of you today and see how you're holding up 12 months, nearly 12 months into this volatile period of market declines. For those of you who haven't met me yet, as I mentioned, my name is John Glougie. I'm one of the senior advisors and associate portfolio managers at Left Financial. And before we get going, I should probably mention that everything I tell you today is on me and not IA Private Wealth. But if you still trust me, follow me down this emotional journey. You may have noticed the last 3 years have not produced a lot of positivity, whether that's in the headlines or just anything you can see outside of your window. Specifically the headlines, though, right? We go back 3 years ago and we started just getting into this pandemic that affected the whole world, the first pandemic in likely all of our lifetimes. So something very new and negative that we all had to deal with for almost 2 straight years. In reality, we're still dealing with it. But about a year ago, we started slowly turning the corner on COVID. You could take your masks on, you could start going back to concerts and live sporting events. But then we were met with nearly 12 months of market decline. So when you go back to 2020 and fast forward all the way to today, we have essentially 3 years of nothing but negativity, right? And you may be reading in the financial section of your newspaper, or if anyone still reads newspapers, or on the internet, whatever website you might be looking at, you're going to see headlines like you see here on this slide, which I stole from Robert in his previous month's little blurb. You might read about, China's economy slowing down, or the volatility in oil prices, or, the Eurozone going through a real gas crunch. And of course, the Feds are raising interest rates seemingly every month to fight off this inflation that just never seems to go away. At the end of the day, all of these headlines have one thing in common. They're all very negative. And that has a real big impact on our emotions and the way we look at our investments, the way we look at the market. In reality, when I pull up the financial websites that I read, I don't even necessarily need to read the headlines to gauge a sense as to how we're feeling today. I just look at the pictures right below them, the stock photos. And my favorite one on this is probably the guy in the top left corner covering his mouth, because he looks like he's never seen a market pullback before in his life. So if they say a picture's worth 1,000 words, I'm pretty sure you could write a novel with this slide. But in reality, these people all look like this is the worst thing they've ever seen, and they're not even certain if we're going to recover, when in reality, in periods like this, in periods of extreme volatility, we can look back at and lean on history to learn from these sort of events. These negative headlines, these negative pictures, this is the sort of impact it can really have on the markets. Now, markets don't pull back just because of human emotion, but human emotions can certainly amplify them. And again, I use this slide that was also in Robert's presentation from the previous month as well, but this shows you what's happened to the markets in 2022. And if you look at a slide like this probably further amplifies your emotional reaction to it. The NASDAQ down almost 30%. The S&P 500, the 500 biggest companies in North America, down over 20%. Heck, even the bond index, the safe stuff, down 14%. There's very little areas of shelter. Where do you run and hide in the periods of this sort of volatility when negativity swirls around everywhere? Well, what I want to tell everybody is we need to put this kind of stuff into context, put some perspective to it. Yes, we're nearly 12 months into the pullback, and yes, it stinks for all of us, but keep this in mind. Go back to the 1950s and stack all your bear markets, the ones that hibernate and pull back, the ones we don't like, and pair them up next to the bull markets, the ones that charge forward, the one that makes people feel very good. And what you'll notice without even looking at the numbers on this slide is that the bear markets, represented by the yellow lines, those are generally a whole lot shorter than the bull markets, the ones that charge forward and represented by the blue lines. In fact, the cuts, as deep as they may be at times, are really no match for the gains that are made in the bull markets that follow as well. So case in point, let's look at the longest bear market that we've seen since 1958, and that was the dot-com bubble of the early 2000s. That lasted nearly 2.5 years. The one that we're probably a little bit more familiar with, or that's still kind of etched in our brain, would be the 2008 financial crisis. And that one felt at the time like it was going on forever, and that everything was going to go to zero, and this time it was different. But in reality, the pullback lasted less than 1.5 years. Look what followed it. We had almost 11 years of bull markets before we ran into COVID. Also, 2008, probably the worst decline we've seen in our generation. And the markets dropped in that short period of time about 56, 57%. The bull market that followed, though, for 11 years, the market charged ahead by 400%. So again, just to put some perspective to this, bear markets, while we're in them, they feel like they're always different. They feel like we'll never get out of them. They feel like the negativity will never end. But in reality, it always does. Now, what we can't tell you is when this is going to happen. But what we can tell you is that on the other end of this bear market, there will be another bull market waiting for us. And if you don't believe me, believe Warren. Because if we get into these periods where we're in this short period of pullback and we have that sense that nothing's ever going to get better and we might as well go to cash because we're going to lose everything anyways, lean on Warren. Warren says if you can't control your emotions, you can't control your money, right? Now is the time to really, I believe they used to say, keep calm and carry on back in the old days. That is exactly what we need to do at this moment. And I'll tell you why. The University of Michigan does a study every year. It's the consumer confidence poll. And what they do is they try to get a sense as to how everyone's feeling, right? Just about investing, about the financial markets and so forth. And what they found was as soon as you had consumer confidence hit their lows, trough out, the following 12 months were generally met by an average return on the markets of about 25%. Now, again, have we hit the low for consumer sentiment, consumer confidence? We don't know. We're not necessarily sure. But if you talk to anybody that has any sort of money in the investment markets, you will probably find that consumer sentiment is low. Again, I don't know if it's hit the bottom yet, but I know that it's already pretty low. So if anybody is thinking about, I can't take this anymore and I need to get my money out and park it in cash, just know if everybody does that, we're probably getting close to that bottom on the consumer sentiment. And if you do pull your money out and go to cash, your investments and go to cash, you may miss that potential 25% rate of return the following 12 months. Again, not to suggest that next year is going to give us a 25% rate of return, only to tell you that when things are at their bleakest, generally they bounce back, the markets bounce back quickly thereafter. The other thing that we always tell ourselves is buy low, sell high. The investment mantra that everybody's familiar with, we all know it, and yet very few of us ever exercise it, right? We're more prone to ride this emotional roller coaster when investing, right? Optimism, markets are going up. We start feeling good about stuff. We start getting really confident in it once we see it being done for a little while. When the market's going probably at its best, that's when we decide we have to get as much money as we can into the markets because look how well they're doing. Of course, when there's any sort of pullback, the first thing we do is say, well, this is probably just a short-term blip, I hope. And then, of course, in periods like we're seeing right now, almost 12 months after the fact, we start entering into this period called capitulation. In other words, we start feeling the need to flood back to safety, flood back to cash. Enough's enough. I'm selling. I can't deal anymore with this. Well, at this point, what we've done is bought high and sold low. We've done the exact opposite of the mantra we're so convinced we understand and that we should always use. Right? As soon as the market bounces back, we still have that reluctance. We're saying, yeah, I need to see this for an extended period of time before I believe it to be a bounce back. And if we wait too long, we miss a lot of the good deals on the market and a lot of the big bounce that follows. So again, if we think buy low, sell high, buy low, sell high, why can't we follow this? Maybe it's because we need to phrase it differently. Buy low, sell high still seems like it's attached to numbers. But today we're talking about emotions. So let's look back at Mr. Warren Buffett again. And what does he say? Well, he says, be fearful when others are greedy and be greedy when others are fearful. So when we look out our windows or when we talk to our neighbors or our colleagues, what do we feel? What sort of environment do we feel we're in right now? One where people are being very greedy or one where people are a little nervous, a little fearful? And I would argue it's probably that people are a little nervous and a little fearful right now. So now is probably not a bad time to start switching on the greedy brain. Because, just to reiterate that point, what we don't want people to do is miss any of the market recovery, and it can happen quickly. So again, I know it stinks when markets pull back, when portfolios pull back, but at the end of the day, as long as we have a strategy, which we do, We are ready for that bounce when it does happen. The only thing we can't tell you is when the bounce does happen, but what we can tell you is it will. So for us, we would say we might not be through this. There may be a few more lumps ahead, but we're already a year into the pullback. So know that the longest pullback in the last 60, 70 years was 2.5 years. That was a pretty extreme example. You know, if that's a worst case example this time, well, we might have a little further to go. But as I also showed you in that graph, the upside on the other side of the bear market was fantastic. And we have to hold on to get to that period of time, which is absolutely around the corner for us. If we have a hard time controlling our emotions, and if we let our emotions get the best of us in times like this, I will look at Benjamin Graham's words of wisdom and tell you that at that point, if our emotions get the best of us, our worst problem is probably ourselves. We're letting our emotions get the best of us. At no time does somebody say, oh, that person let their emotions get the best of them. That's generally not a good comment. And it's no different with the equity markets. And if you're curious to know who Benjamin Graham is this is the fella who taught Warren Buffett essentially everything he knows about investing. So again, yes, the markets have not been fantastic, to say the least. It's been a tough year for all of us together, but there are positive days ahead of us, that I can assure you. And if I'm wrong on that, the good news is we do teach another course. It's a little longer than this one. In fact, we like to hold it in person at our Luff Financial bunker up in the interior, where we tell you all about how to fight off the zombies. And Robert has a nice little segment where he teaches you how to cook squirrels. So I'm sure some of you have seen this course advertised before. To date, we've had no one sign up for it, and that's probably a good thing. Again, today was more about just reaching out, touching base with all of you, indirectly, I suppose, but just to check in, put some perspective to the markets that we're in right now, maybe sprinkle in some optimism to know that this bear market we're in right now is not a forever thing. It's a very short term in the grand scheme of things thing. Thanks so much for checking in today. I look forward to kind of seeing you. I guess you saw me more than I saw you, but I look forward to seeing you all again soon in person, because we can do that now. And that in itself is a very positive thing. Thanks, everybody. We'll see you again soon.